Hey guys, my name is Aliyu Justunia. Today is the 6th of 30-day series where I promise to teach you forex trading from zero to hero using ICT trading concept completely free. In today's lesson, we are going to learn top-down analysis for different trading styles. We will cover how to properly analyze the market for position trading, swing trading, day trading, and scalping. Top-down analysis help you understand the bigger picture first before looking for interest on lower time frames. Yes. Once you master this skill, you will stop trading randomly and start trading with clear direction, structure, and confidence. So let's dig in. So what I'm trying to let you understand, if you could remember from our introduction, I told you about the four types of trading style that we have. I just mentioned them now. Position trading, swing trading, day trader, scalper. Yes. So you to start doing a top-down analysis, you don't need so many time frames. And I promise you, if you did not do your top-down analysis correctly, you will keep losing money. Even though top-down analysis is not something difficult, but it is something that if you are not doing it correct, you will keep losing money. You will keep hitting SL back to back, back to back. But if you are doing it correctly, then you are fine. So to do your top-down analysis properly, all you need is two time frames, sometimes three, but all you need is two. Which one and which one? Your bigger time frame, the one that you are going to do your analysis on, and the second one is the time frame that you are going to do your entry on. For example, let's draw some structure like this. As I told you earlier from our previous classes, if you have structure like this, what you are going to buy, right? You are going to buy, and don't trade against the trade. What is trend against the trade is market is moving like this. What market is doing? Market is uptrend. That means you should buy, right? Once market is moving this way, that means market is moving down, right? What are you going to do? You should sell, right? And they keep saying don't trade against the trade, don't trade against the trend. That means don't swim against the flowing river. So if river is going left, try to swim left, but don't try to swim right, because you are swimming against the flowing water. So it will just scatter you and do what it wanted to do with you. But if you are following a flowing river, so it will be easier for you to swim, right? Sometimes even if you don't know how to swim, water can just carry you along. Maybe it will just dump you somewhere in, I don't know. I don't want to mention it. So let's assume this is our structure. So for you to trade as position traders, they are the types of traders that they will hold trade for like months, some of them even years. Those are the position traders. And swing traders, what are those type of traders? They are the type of traders that hold trade for what? Hold trade for like for like um for like weeks, sometimes even months. For example, the highest is 1 month, but can 1 week, 2 weeks, 3 weeks, even 4 weeks. Highest is 1 month. And day trader, they are the types of traders that they hold trade for only 24 hours, nothing less, nothing more than 24 hours. Sometimes 1 hour, 2 hour, 3 hour. Those are the type of those are the uh, day trader day traders. Scalpers, they are types of traders that hold trade for like how many, like minutes, maybe 1 2 minute 3 minute, highest 1 hour. Those are the scalpers. If you are holding trade for more than an hour, you are day trader, not a scalper. Yes. So how are you going to how are you going to do a top down analysis as a position trader? As a position trader, we have two ways to start your top down analysis as a position traders. You have two ways. It depends on how long do you want to stay in the market. Yes. Sometimes if you want to stay long for years in the market, you will start your analysis from what? Monthly time frame. Let's say this is your monthly time frame as a what? As a position trader. This is your monthly time frame. All you have to do, just come and see where exactly market is going. Market is uptrend or market is downtrend. So from then mark your order block. That's your point of interest where you want to use to enter a market. Mark it from that monthly time frame. Yes. Then after that, you have two options. It is either to um, use confirmation entry or to use aggressive entry. I'm going to teach you confirmation entry and aggressive entry in my next video. So don't worry about it now. So the first one is aggressive entry. Once you understand market is going bullish or bearish, something like this, all you have to do, just carry your what? Carry your position tool and put your pending order, or wait for price to come back here and enter that trade. But the problem is that this one, it has a bigger stop loss, and it kind of riskier. So what I'm just trying to tell you, that if you are aggressive trader, sometimes you don't even need two time frames. All you need is just one time frame, just to look for structure and just put your pending order there. So but if you are a what if you want to use confirmation entry, so what you are going to do is that from a monthly time frame, once you mark your structure from monthly time frame, then what? You wait for price to come back to here and take your buy. But are you going to trade from that monthly time frame? No. You are going to step to what? Daily time frame. Because every time frame, it has its bigger time frame and it has its lower time frame. For example, monthly time frame, 2 weeks is not a smaller time frame for monthly time frame. 1 week, it is not a smaller time frame for what? Monthly time frame. It is what? Daily time frame. So from monthly time frame, you will step to what? You will step to daily time frame, because if you come back to a daily time frame, you will start seeing something like this. Structure is coming back slowly, coming back slowly, coming back slowly, coming back, slowly, something like this. And if it's going back, it will start doing something like this. That's how it is on lower time frame. So, and if you like, you don't have to wait for market to come back here to you can take advantage of this retracement, because you are very sure market will retrace back to here, right? So when you step to 1 minute time frame, you look for change of character from here. That's when you will join your trade. I'm going to explain more about this. And at the same time, if you want to use weekly, that means you look for confirmation and entry on what? 4 hour. But I'm not going to waste much time here, because me, I'm not a position trader. Mostly I use a swing trading and me, I'm using swing trading and day trading, sometimes scalping. Yes. So I'm going to, pay attention to swing trading and day trading. Maybe I will pick one of them to explain more. So so if you are what if you are, let's say, swing trader, you will use what you will use um you will use daily time frame. Do your analysis there, something like this. Let's assume this is daily time frame. Do your analysis there, then drop to 1 hour, and look for your entry. I'm going to take one pair as example to analyze, but I just want to finish explaining these things to you. So but normally I don't really use this method also, because I don't want to stay long in the market. So I use most of the times 4 hour, and look for entry from 15 minutes, or 1 hour, look for entry from 5 minutes, or 15 minutes and look for entries from 1 minute. That's how it is. So how are you going to do that? So if you are going to use 15 minutes and enter market with 1 minute, so you are going to do something like this. Let's say you mark your structure from 15 minutes, and drop to 1 minute and look for change of character. Once you get that change of character, then do an entry. For example, 15 minutes, you are going to market will look like this. It has like smaller structure uh from from yeah from 1 minute. It will do something like this. Then that means you have change of character here. Then market will go back. I enter from there, then continue selling, continue selling, continue selling, continue selling, continue selling, till market reach here. When market reach here, you are not going to jump into market direct. From that 1 minute, you will wait for market to give you another change of character here. That means you get change of character. Then maybe you look for peer value gap or order block, or any one of the um, institutional reference point, and use it to enter trade, something like this. That's how you will enter market. So the same thing if you will use 1 hour and 5 minutes, the same thing if you will use 4 hour and uh, 15 minutes. That's the concept. It is not something difficult. So there is one thing that I did not mention. Sometimes, if you are going to use, let's say, 15 minutes as your structure, it is a good thing sometimes to look at a bigger time frame for 15 minutes. What is the bigger time frame for 15 minutes? Is 4 hour. As you can see, your entry, yeah, this is it. Bigger time frame for 15 minutes. It is not 30 minutes. It is not 1 hour. It is 4 hour. Yes. If you are to if you are going to use 1 hour and 5 minutes as your a time frame combination, so sometimes it is good thing to look at the bigger time frame for 1 hour, that is daily, but once in a while, not all the times. The same thing for 4 hour. It's good to look for bigger time frame for the 4 hour. Which is bigger time frame for 4 hour is weekly. Yes, let me explain more. For example, um for example, it will be like this. Weekly, then from weekly you drop to what you drop to 4 hour. From 4 hour you drop to 15 minutes. 15 minutes to look for entry. But if you are going to use what, 1 hour, which is the bigger time frame for 1 hour, is daily. From daily you drop to, um you drop to what, 1 hour. From 1 hour you drop to what, 5 minutes. 5 minutes for your entry. And if you are going to use the other, this thing, 15 minutes, maybe from 15 minutes you look at what, 4 hour. Then from 4 hour you look at what, you look at what, 15 minutes. Your 15 minutes, that's where you will mark your structure. Then from there you drop to 1 minute for your entry. So all these time frames, you can't just go and start looking at them randomly. No, there is specific what you want to look for in all of them. For example, if this weekly, if you are using this set weekly, what you are going to find out in weekly is that what is the market direction. Once you understand the market direction, that means where market is going, then you drop to 4 hour and start marking your structure like this. Yes, toward the direction that that weekly time frame is going. Then if you are using this, the same thing, daily you look for direction, then 1 hour you mark your structure, then 5 minutes you execute your entries. The same thing for this. So let me, I think, take BTC. Let me use BTC as an example. For example, I'm going to use 4 hour structure on this BTC. So let me look at weekly. I don't need to look at weekly all the times. All I need maybe once in a while to look at weekly time frame. So what am I seeing from weekly time frame? From weekly time frame, I'm seeing what? I'm seeing what is even the market direction from a weekly time frame is bearish. Why did I say bearish? Because as you can see here, we have what? We have change of character here to a downside market structure shift. And as we can see, we have this structure to the downside, break of structure, and what, this is our what, displacement impulsive move. Then market will go back to this LVG. Market will go back to this LVG. So what is my direction on weekly is what is bearish, right? Is bearish. So does that mean I must sell? No, because this journey from this to this FVG is a 1 week trend. Like it's a perfect uptrend for even a week or even 2 weeks. So that means if I drop to 4 hour, so I'm going to have like uptrend here. Yes, that's how the top-down analysis is. So let me drop to 4 hour. So if I drop to 4 hour, if I drop to 4 hour, I know that market will go back to this FVG. So I'm going to do my market structure heading here. I'm going to what? I'm going to sell. I'm going to buy. Even though market from a weekly time frame is bearish, but on what, 4 hour is what, bullish. So let's start our marking our market structure. So as you can see, market from here, it coming down, coming down, coming down. Here, do we have change of character here? No, we don't have change of character here. Market coming, coming. Do we have change of character here? No, we don't have change of character. Why? Because this retracement is not a valid retracement. Because valid retracement like start with at least 3 candles that are closing above each other. So this is not a valid retracement. So we are not going to consider this as retracement. So market coming, 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 coming. For example, here, I think we have change of character here. That is market structure shift. So as you can see here, we have what? We have we have we have this order block here. So we can just mark this as our structure at that time when market is here. And as you can see, market come back, tap in, and dish out this buy. And from here, we have what? We have also we also have this what? We have this. This is what? This is another order block because we have this structure. So are we going to what? From here to start buying from here? No, 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 no. We are going to wait for market to reach here. When market reach here, then we will drop to what? 15 minutes. From 15 minutes, we will look for what? We will look for change of character. As we can see, market is going, 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 going. We did not get any change of character. We did not get a change of, even though we have change of character here. Do we have change of character here? I think we have change of character here, right? We have this candle. Okay, it is not a valid change of character because it has not closed above each other. But what about here? We have change of character here. We have this change of character here. And we have this FVG, and we have what? We have another one. So do we do we have market structure here? Yes, we do have market structure here. So so where are we going to have our entry here? So we have this FVG here. We have this FVG, and we have another FVG here. We have another FVG here. So where are we going to enter from them? Among them, which one are we going to use? So let me use my Fibonacci tool to see which one is inside discount and which one is. So clearly you can see this one is not inside what? Discount zone. So that means this one is the valid one. This one is not a valid one. So how are we going to position for this buy? We are going to position like this. Use this FVG. Put my stop loss here. Somewhere like this. Then what? We are going to position to. We are going to buy. We are going to buy to this point. To this point. How many risks reward? 1 to 9. Normally we should keep buying. Maybe when we when we hit TP here, we are going to what? Continue. We are going to continue buying till we reach here. Somebody might say, so why are you trading against the trend? No, I'm not trading against the trade, because the retracement that you are seeing, even if market is downtrend on weekly time frame, that retracement that is going to happen on that weekly, if you drop to 4 hour, it is a good uptrend. So as you can see, I'm following the trend. I'm still following the trend. And at the same time, this thing that you are seeing is going up. Maybe once the market reach here, grab this this buy side liquidity. So market will return back to this FVG, and then from there it will continue buying till it reach here. So if I like, I can drop to another time frame, maybe 15 minutes. Then I will consider that retracement that will come back for this FVG. I will consider it as another downtrend and continue selling till it reach this FVG. So that's how the time frame navigation is, time frame alignment. I mean, so let's go back to my 15 minutes that I'm trying to take buy from. As you can see, but market did not reach where we wanted to buy from, which is fine, which is fine, which is fine. Then maybe you can look for another different entry. Maybe here we have what? We have break of structure here, and here we have this what? We have this FVG and order block. So we can just go ahead and you know uh, use it. And we have this small FVG here, which market tapped into it. So if you miss this, because this should be a valid one, but market surprised us and it didn't come to our discount zone, which is fine, because market can do what it wanted to do. So then from here, maybe we can join, maybe here, and put our stop loss here. As you can see, market is moving like it give what? 1 to 7 risk reward should be the stop loss. So that's how you will continue uh, joining the trade. We are going to talk more uh, on entry, because we have more topic to cover. We have this trade entries, which we are going to discuss about aggressive and confirmation, and we have this trade entry models, which we are going to discuss about ICT 20. So we are going to talk more on this top down analysis and entries. So I think this is going to be the end of this video. The video is long already. So bye guys, see you on another video, on our next video.